Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. It's been 6 months since we last had a chat with Marcus Phayre-Mudge, the manager of TR Property, the listed investment trust that specializes in investing in other commercial property ventures and also invests directly in property as well. So 6 months have flown past, Marcus, and they've been quite exciting 6 months in terms of global markets. But the UK property sector, at least, and European property sectors seem to be, well, they seem to have stabilized and seem to be signs of some more green shoots out there, I think.
Absolutely, Jonathan. And as always, nice to join your podcast. So yes, we published our full year results to the end of March earlier this week. And all of that is available on the trproperty.com website. But actually, it's interesting that there was I, along with my chairman, Kate Bolsover, writing our outlooks. We were by the end of May. And of course, things have moved on dramatically from March to May, as much as from December to May when you and I last spoke. I think the analogy I've been using is that the surface of the pond is very choppy. And we are seeing lots of volatility in the wider market, lots going on driven by geopolitical factors, amongst other reasons. But actually beneath the surface, the fundamentals for the world of real estate have actually been steadily improving, which may come as a bit of a surprise to some of your audience. But we're beginning to reap the benefits of essentially a very subdued development cycle over the last decade. And this actually goes really all the way back to the sort of repercussions of the global financial crisis, which I've talked about before, which is really the banks, the natural providers of speculative debt funding, just very much disappeared from the market. And what you saw was that being replaced by long-term capital, private capital invariably, but some of it being superannuation funds, etc., big global players. But they were looking for lower risk products. So they were very much happy to back the development when it was at least a third, if not a half, or even fully let. So essentially pre-let exposure, or some exposure to markets where demand was very much robust. And we saw that with industrial, logistics, etc., post-COVID. So we're now in a situation where, in fact, for many of our sectors, particularly at the prime end, we actually have a shortage of buildings and a surfeit of demand. And that would particularly apply to CBD offices, where everybody is realizing that you really do need to get back into the office at least most of the time, if not almost all of the time, in order to conduct business and grow your internal staff skills, etc. And we have seen rents here in the West End move up really quite rapidly and touch super prime rents of touching £200 a foot now. Meanwhile, we can still jump on the Elizabeth line and go all the way down to Canary Wharf, where there's, because it's very much a financial services focused tenant group rather than a more broader audience, there is quite a lot of space because quite a lot of it is now looking a little elderly. So essentially, for us, there are markets where we can get access to particular types of real estate and see that rental growth, and it applies to lots of sectors, which I'm sure we'll talk about a bit later. But really, the other sort of feature of the market, and which has really helped drive, since the end of March, TR Property's NAV and share price have risen by over 11%. And this has actually come about, we think, because of the expectations for further falls in interest rates and particularly stability in the long end of the curve. And that has then been sort of almost matched or enhanced by the fact that there's been a lot of competition for lending. Bond markets are well and truly open and spreads continue to tighten. And we're seeing, particularly across our European companies, many of them who utilize the bond markets for debt rather than bilateral financing with banks, they're all raising 6, 7, 8, 9-year money inside 400 basis points all in. So from a real estate point of view, that's very attractive, particularly if your shopping centre is yielding you 8.5%. So we're back to positive earnings accretion. So when we look at our world as a whole, I've got lots of companies yielding me 5, 6, 7% dividend yields. Earning yields are even higher than that, and rents are growing. A lot of it is index linked. These listed companies have managed their balance sheets this time around very well. We have a collective loan to value across pan-European real estate equities of about 32, 33%. Any private property company would give their eye teeth to that sort of low level of leverage, because it does give you lots of firepower to go out and either spend money on your existing assets, bring them up to better quality, or go out and make further significant acquisitions. And a couple to highlight would be Landsec buying Liverpool One, the huge open-air shopping centre in the middle of Liverpool. Another example will be our big French exposure, a company called Klépierre, who've bought a shopping centre called Roma Est, which is aptly named as it's east of Rome, for sort of 280 million euros. These big companies are having an opportunity to flex their muscles and use their balance sheets for highly accretive acquisitions.
Well, beginning to swoon here under this volley of positive news and vibes coming out of you. Surely this can't be happening. Well, if we just pick on two things then, I mean, obviously we know that economic growth and interest rates are fundamental to commercial property valuations. On interest rates, I mean, you're confident, are you, that the long end of the bond market is going to behave itself? I mean, obviously yields have been rising in the longer end of the curve in some places, though obviously that's mainly in the US. So how much of this confidence we're seeing in the sector is stemming from that belief in interest rates, or is it more that there is some more fundamental in terms of growth and lack of capacity, as you mentioned at the beginning?
Well, as always, Jonathan, you've hit the nail on the head with the $100 million question. And the answer, quite simply, is we don't know exactly where the long end of the curve is going to settle over the next few months. What we are encouraged by is the access to capital for these companies and the spreads over that rate. And we are seeing smart finance directors all over Europe tapping into that market now and essentially saying, look, we think it's probably going to be around these levels for the foreseeable future. Of course, should there be further concerns around either inflation or geopolitical risk, that of course can move up, and equally it can move down. But most of these companies like to be able to spread their debt costs and their debt maturity. So for me, we have to deal in the here and now. Two things that are much more fundamental for us is actually getting out of a zero growth environment. And that's where Germany is so crucially important to Europe, and the fiscal bazooka is so crucially important, not only to Germany, but also to the wider economy. And yes, that, of course, on the face of it, could drive the long end of Bund yields upwards. But I think what is more likely is that transmission from diktat to spend by government is going to take some time. But more importantly, in the short run, it gives businesses confidence that their order books will get filled in the future. And this isn't just about munitions and armament. This is really about infrastructure, and also about, there's, I wouldn't say benefits of deglobalization, but there's certainly, from a real estate point of view, more stuff. It needs to be stored and made in Europe, rather than relying on it all coming just in time from Asia. And we're already seeing this with very encouraging results from our biggest Eastern European developer, a company called CTP, who have had so much inbound from global companies based in Asia wanting to expand their footprint domestically in Europe. On top of that, European equity markets look incredibly cheap still, even with the DAX being the top performing market so far this year relative to the US. And I think an understanding from a lot of fund managers that maybe having only endless growth stocks with 3-digit PE multiples is not quite as safe a place as it might be. But for us, we come back to that rather boring fundamental equation of supply and demand. And you're quite right. We remain very negative about a 1990s office building on a business park somewhere outside Swindon. That is not a fit for purpose location companies don't want to be on those business parks. They're hard to get on and off at peak times. The buildings are elderly and need money spent on them, and there's no amenity for tenants. What they want to be is city centre, on top of transport hubs, not relying on cars, with proper end of journey facilities. So that's showers, bike racks, cafes, somewhere to store your Amazon parcels, etc., etc., etc. And we can apply this to all sectors. It's really just about making sure that you expose yourself to the right asset class. And there we are going to continue to see rental growth because there is a fundamental shortage of an awful lot of this kit.
I was just going to make a comment that, as you know, I live in Oxford, and Oxford doesn't seem to be suffering from lack of new build, shall we say, around the place. But that may be specific factors. Anyway, that's certainly an indicator of something's happening.
Well, it's worth just touching on that, actually. And the reason, quite simply, most of the cranes that you will be looking at in Oxford are attached to developments that are pre-let. However, there is one UK REIT, which we have never owned shares in and still don't. I, to be quite frank, probably never will. And that's called Life Science REIT. Its mnemonic is Labs. And that is a business that owns, amongst other things, something called the Oxford Technology Park, which is all well and good, except it's not in Oxford. It's about 6 miles outside on the old rugby ground. And I think it's a classic case of when markets are running full steam and super hot and there is no choice, then occupiers will accept second or third choice and move to an inferior location. But when there's still options closer to where they'd like to be, the CBD, then they will take up that opportunity. The reality for Oxford Technology Park, it hasn't been that there's an awful lot of competition. There isn't, and that's why they went ahead and started building it. It's the fact that temporarily demand has dried up because many of these tenants or the tenants who were in the previous cycle taking up this space were startups, they were venture capital funded, Series B, C, D, and that market, because interest rates have risen so dramatically and because of insecurity around government policy, etc., a lot of those businesses have retreated to the United States or just haven't got off the ground. And in fact, that's a classic case of where there is very little supply, but right now there's really very little demand.
That brings us back to the investment trust sector, because obviously Life Science REIT has not been a star performer, I think it's fair to say. I think it's trading at 40p or something, which is well below where it was issued at, obviously. But we have seen a lot of activity in the investment trust sector. In fact, it almost seems to be accelerating by the day. And you've been quite active in that. What do you make of the latest deals that we've heard coming out of the investment trust sector? And what do they tell us? They tell us something about the demand, obviously, but do they tell us anything about the valuations across the sector?
Yeah, I mean, it's been an incredibly busy time in the world of M&A. We've always made a point to investors that don't try and do rifle shooting yourself, just invest in TR property, which as a closed-ended permanent capital vehicle can build positions in these small and micro cap names and work with the manager and the board, helping them understand what it is that investors want. And either they are able to achieve that, be it an increase in earnings or a move to internalization or whatever it may be, or if they can't, then encourage them to seek to consolidate with others. And if not, they run the risk of being gobbled up by private equity. So the themes that we've now been seeing lots of, and as you say, over the last couple of years and now very much seem to be in the sort of final phase of acceleration, has been particularly concentrated on the externally managed group of REITs and trusts. And I think there's been 3 reasons for that. The first is that investors have realised, and Labs is a classic case, where the shares were issued at £1. I think the last published asset value was 70 something pence and the shares are 42 pence. But the management contract, which the manager is being paid on, is based on the NAV, not on the share price. You immediately have a misalignment where the manager is focused on maintaining the NAV at a high price and the shareholders can only eat the share price and the dividend, although there obviously isn't a dividend in that particular company. So, and we've seen this in other examples where boards have woken up and realized that they need to switch to a market cap based fee, which is what they've been busy doing. In fact, the latest on that news was yesterday, where Schroeder REIT announced that they're moving to a 50-50 market cap and NAV. So they're at least going some of the way. The second feature has been that a lot of these vehicles were really quite small. They were created in a period, sort of almost a vintage from 2015 through to 2020, where there was a desperate desire, quite rightly, from the wealth management community for income. And property is a natural provider of income. Over a full cycle, over 80% of the return comes from income on an unlevered basis. And they attracted capital from the wealth management community. But in many cases, they just never managed to scale up enough. Meanwhile, the client base, the wealth managers, have themselves all busily consolidated. If you think about, Schroeder and Cas Cap, Investec, Rathbones, Smith & Williams and Tower Tilney all becoming Evelyn Partners, etc., etc. The list goes on and on. You've seen it across the IFA market as well. And these managers really don't want to own 15% of a 300 million market cap business. They'd much rather own a smaller amount to a much bigger trust. And so they've been right behind this as well and supportive. And then you've had situations where management teams have just shot themselves in the foot. And the classic case of that was Urban Logistics REIT, where the manager proposed and the board accepted, to be quite honest, a completely bonkers internalization proposal that would have cost shareholders a lot of money for no real gain. And we felt so strongly about that we actually joined with an activist, Achilles, and another large long-term shareholder, Waverton, to seek a resolution to remove various members of the board. And we would have won that, quite confident of winning that EGM, but in the end we were able to withdraw it because there was a bid for the company by London Metric, which was essentially an elegant exit for the board. They avoided looking sort of silly and have managed to done a very good deal by getting shareholders out at about a 3% discount to NAV. So to finish off on that last point, Jonathan, about discounts and pricing and NAV, the market isn't stupid. It is a very efficient measure of value. And in the case of Urban Logistics REIT, the market and the bidder all had the same view roughly about what the NAV of this company was. Whereas in the case of Warehouse REIT, we have an odd situation where Blackstone originally had their bid accepted subject to due diligence. They did some more due diligence and found something in the DD. They withdrew their bid at 119p and have resubmitted at 109, which has again been accepted by the board. Yet the independent valuer between September 24 and March 25 hasn't actually materially moved the valuation of what includes a very large development site outside Crewe called Radway Green. And certainly, the one part of the commercial real estate market that's always extremely difficult to value is land, whether it has planning permission or doesn't have planning permission, because essentially the value of the land is the residual from your development appraisal. So after you've hypothetically worked out what it's going to cost to build all your buildings, what you're going to rent them at, what the exit yield is, how long it's going to take you to let them, et cetera, the incentives you've got to give, and then your risk rate that you wish to apply. And that will then spit out a number, and you get a very broad spread on that. So essentially, we think that Blackstone had another good look at that site and realized they couldn't possibly bid what they would pay for it. So what does this highlight? The fact the board are prepared to recommend a figure of 109 when the valuation, according to CBRE, is 126. It's really just to remind investors that the NAV is an art, not a science. One man's NAV is another man's novel. And I think that really we get back to what's already very much the way things are done in the United States, in the world of REITs in the United States, is it's all about earnings. It's all about income. And that is what, at the end of the day, however much I try, real estate will always be the value end of the equity market. You could argue it's at the growth end of the bond trade, I suppose, because on the basis it's earnings that are exposed to earnings growth and underlying economic growth. But we're never going to be a growth equity story. And really, it's all about income. And it's that discipline of paying dividends out of earnings, not out of returning capital, that I think investors are realizing is fundamental. And they have quite rightly abandoned something like labs where the earnings are pretty well non-existent. I mean, obviously, they suspended the dividend.
So across the piece there, looking at the investment trust sector, I mean, it is interesting looking through the sort of charts of the sector. All the ones that have had some kind of M&A activity, whether it's private equity or mergers and so on, they've all had a nice little spike, shall we say, a significant spike in some cases, but the sort of exits that have happened have been generally below NAV, I think. And I'm sure it's not just down to the fact that the managers are being paid for NAV rather than share prices, that's the situation. But what does it mean for the rest of the sector, the small part of the investment trust sector that remains? There's some quite small vehicles there. You mentioned size as a factor. What do you think is the outlook for those? Obviously, we're thinking about things like custodian. Almost every day seems to bring news of some activity anyway around the sector. What's the outlook for those?
Yeah, I think actually we are getting close to the end game in as much, Jonathan, that there absolutely is a place for a handful of these small real estate trusts, particularly those that have been able to exhibit recurring earnings growth, but also are starting at a healthy covered dividend yield of kind of circa 7. And you've mentioned custodian. I would class AEW as another one. The Schroeder REIT vehicle seems to be able to maintain a much tighter discount. And then more recently, a stock that we own a lot of, Picton Property, has very much gripped the bull by the horns and is undergoing a buyback program, which is exactly what they need to do. And we've seen the share price move from 60p to 80p. But I think that's compounded by the fact that, as per the chairman's statement in the annual report put out last week, that the chief exec realizes that he needs to increase his income. And in fact, there is a group of investors who are, it appears, prepared to forego some potential total return, some potential capital gain in return for that higher yielding play. Because ultimately, if you own high yielding real estate, it's because it is high yielding for a reason. The leases are shorter, or the rental growth expectations are lower than a primer asset, or there's capex that needs to be spent on the building again, it's all very efficient in that respect, but there's absolutely a place for that. And if you look at the registers of custodian or AEW REIT, or to an extent Schroeder REIT, you will see that that is dominated by private investors owning the shares directly through the platforms, through Interactive Investor, AJ Bell, etc. And I think there is a home for that. What there isn't a home for is those businesses that have been essentially probably mismanaged. Now, we have some great success stories of internalization, the obvious one being Supermarket Income REIT. So we're now getting alignment in that business because that business has internalized, and shareholders have benefited hugely from, yes, we had to buy out the external management contract, but the return on that is circa 20% per annum. We'll get all of that capital essentially paid back to us in reduced G&A costs over the course of 4 years. So it's been absolutely worth it. And of course, we've had a pop in earnings, and that share price has gone from strength to strength, and it's big enough. So I probably need to be careful. I didn't mean that NAVs were being in any way manipulated. It was more just that the alignment was wrong. But I think what we do have to realize is, when you amalgamate a couple of small trusts, which are circa 350 million market cap each one, you get some extraordinary high cost savings just through removal of one layer of cost. And when you look at London Metric, which has been the diversified name that's been the sort of key consolidator in the sector, having not only sucked up Urban Logistics REIT that I just mentioned, but prior to that, it was CPPT, LXI, Mucklow. I mean, this business is now in the FTSE 100 as a consequence, and he just keeps on grinding the earnings upwards because he's able to take out so much cost, reduce costs in the process. So I do think, in conclusion, that there is a home for these smaller names. I would like to see a bit more consolidation. We never really want to see take privates because we're losing businesses from the listed space. But there are some companies, and Warehouse REIT would be a classic one. We will vote in favour of the sale to Blackstone, where there isn't another team in the listed space who we think can run those quite complex mix of assets. We think that actually that'll be better run by the Blackstone team. But bear in mind, the Blackstone team that are running it are the team from Industrial REIT. Industrial REIT was a business that was taken private in April 2024. We owned 12% of Industrial REIT. It was a 40% premium to the undisturbed share price. So, it was a bittersweet moment for us. I remember talking to you about this in the past. But Julian Carey and his team have built a really fantastic management model, which Blackstone thought, well, we'll have that. And actually into that Blackstone fund, which is called Indurent, will go not only Warehouse REIT, but already they have the industrial portfolio and a business called Handstein. And then in some point in the future, as private equity, they will need to look for an exit for that. And we hope that the tidied up and resolved management issues will end up with that company potentially coming back to public markets, larger and more liquid.
That will be something, yeah. You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Obviously, there's been some activity in healthcare commercial property, I should say, and there's been a kind of tussle over Assura, and we've also seen the departure of what is now Care REIT. What do you think's going on in that sector? What do you make of that Assura situation?
Yeah, I declare the fact that we owned a lot of shares in primary health properties.
Which was a rival bidder, as it were.
It was absolutely, and we always felt it was a better run business. It had a better return profile, capital deployment profile, etc. So the board of Assura had agreed in an effort to push up their earnings. They had deviated away from just NHS-backed primary health property and moved into private funded hospitals. And they bought a bunch of hospitals from some people called Northwest, which is a Canadian business, but they bought it for a mix of cash and shares. Unfortunately, those shares then immediately the market considered that to be an overhang, and the Assura share price drifted downwards as everyone waited for Northwest Capital to place those shares. And that was a moment of weakness for Assura, and along came KKR. But from our point of view, we're not surprised that KKR have come in at this point. The primary healthcare sector has suffered for a long time by the fact that the valuation office, the government body which sets the rents for these new facilities, was not keeping up with the market. And what I mean by that is if the cost of building new primary facilities has gone up by 35% over the last 2.5 years, well, the rent that you charge needs to also rise by a similar amount. Otherwise, we're just not going to build these things. And that essentially is what happened. And I think KKR realised that not only here's a chance of the cost of funding is going to continue to decline, or at least it's now stable, but actually they're probably betting on, as we are, that this government will loosen the purse strings, as we discovered in the spending review yesterday, and some of that must filter down into how do they get more of the real estate that we need, and to take the burden off hospitals by having more diagnostic and actual treatment facilities at the primary end. So we think the loss of this big portfolio of listed assets would be a great shame. So we are absolutely pro the merger of PHP and Assura in a part cash, part shares bid to create what would be a really healthy sized REIT. And, we've been public about the fact that we will vote against the cash bid that's recommended by the board. And it is interesting to note that KKR announcement yesterday of their revised offer also moved to 50% of all votes rather than 75% of votes cast by moving the form of their offer. So they're trying to go about it in a different way. But we'll wait and see. I think it would be a great shame if we were to lose those assets from the listed space.
I would agree with you, actually. I have some exposure there myself. And in terms of the other specialists, primary health is one thing, care homes is another. Are you interested in that market? Is that one that interests you or not?
Yeah, we have shares in Target Healthcare, which specialises in very high-end nursing home facilities. I think the private healthcare market is always an area of concern because the underlying operators are themselves, these are businesses where 90% plus of your cost, X your real estate, is staff. That is what your business is. You're in the care business. And that, of course, is always at risk of increases in costs through NI, minimum wage, or changing government legislation towards overseas care workers, etc. So that's always quite a difficult one. But the demand is strong, and its private pay seems to be relatively immune to these cost increases, whereas government-funded homes, there continues to be sort of endless battles on increases in fees, quite rightly, because there isn't enough money to go around from the state. So that's where we're exposed to that. We weren't in the adult care sector as exposed through Triple Point social housing because we didn't believe in the business plan and the previous management team. But that is an externally managed business that's just been taken over by a team backed by a Trato. Now, it's not the same individuals who are running the supermarket income REIT. They've got a new team, but the financial rigor that Ben Green and Steve Winder brought to a supermarket income REIT, they're now bringing to Soho. And we have now built a position in Soho, social housing REIT, because we think that that's a very interesting area. Now, this was sold always to the market as long duration assets, government backed. It is long duration in as much as many of the patients in these homes are young and have long-term care needs and will need to live in these facilities for sometimes their whole lives. But again, it's understanding who the operator is, their balance sheet, their operating margins, etc., and making sure that they're the right people. And what we've seen already is Atrato sort out quite a lot of the operators in those businesses. And I'm quite interested in that sector, partly because as a defence, if we do get a significant economic slowdown, there are a large number of kind of what I would call needs must sectors which will continue to pay the rent whether the economy goes into a recession or not, just to take an extreme version, and supermarkets would be a classic one to tack into that group. At the same time, the market has really taken the shine off sectors that are seen to be very economically sensitive, and the most obvious one in our space for that is self-storage, where you can rent a unit for your minimum contract is 1 month. And we think that sector is beginning to offer real value, share prices having rattled down from, in the case of Big Yellow, from £16 to £10. But the likes of both Big Yellow and SafeStore now own estates that are utterly irreplaceable. It's so hard to find a piece of land, to get the planning, to build a self-storage facility with the road frontage that you need, the visibility. Certainly in any one of the 7 largest conurbations in the UK, it's proving very difficult. So we think that the market is undervaluing those sort of operational businesses they're operating not an entire oligopoly, but they have what we call an eyeball oligopoly. And if you type self-storage and your postcode into your laptop, it'll be impossible for you to avoid getting a price from either SafeStore, Big Yellow, SureGuard, Access. And therefore, you are already part way through that customer journey, because the hardest thing for business is identifying the customer. But if the customer pretty well comes to you, then that's a great step in the right direction.
So there could be value there. I wanted to ask, just before we leave the investment trust sector and come back to TR property itself, are we any clearer to knowing how significant a factor cost disclosure has actually been? There was obviously a lot of talk about that last year. People said, it's ridiculous that SEGRO can do this, report costs one way, and listed investment trusts have to do it a different way. That's the first part of my question. And the second part of the question is to do with discounts generally. I mean, looking down the sector as a whole, some of the share price performance generally, we've seen discounts coming in a little bit. And obviously, particularly where there's been M&A activity. But do you think that trend has got any further to run?
So answering them in order, I think impossible for us to say how much impact the levelling of the playing field on cost disclosure has been. Although if you use the obvious example of SEGRO and Tritax Big Box as 2 big listed names and the relative share price performance, we think it has had an impact. And that has helped investors realize that one isn't a lot more expensive to run than the other. They are incredibly similar in many respects. That's been helpful. We just can't quantify it. So we would consider it to be a gentle tailwind, I suppose is the way to best describe it, which I think will persist for a while. On the subject of discounts, absolutely. But really, again, to me now, the discount is almost a sort of output. What I'm looking at, and I will pay a premium for earnings growth if I think I'm in an asset class run by a bunch of folk who are going to be able to extract a value over and above their competitors in a market where I think we are going to see a shortage or a spike in demand or stability or whatever. Now, in a perfect world, I'm buying something that's giving me that, and I'm buying it at a whacking great discount, and the market's going to wake up, or at least I'm protecting myself from M&A activity. So I think, yes, we are going to continue to see discount narrowing as more sectors get more evidence of pricing. Having said that, something like secondary office markets remain very difficult to price. So I wouldn't say that something like CLS Holdings or Regional REIT are going to see narrowing in their discounts, because those businesses, not only are they in sectors that still require a lot of capex or improving of secondary property, but their balance sheets are, to a greater or lesser extent, somewhat impaired or restrictive. So I'm not surprised by those very large discounts, and we're not attracted to those because we're attracted to quality earnings growth. But would I be a happy holder of PHP if it was able to merge with Assura, even though it was then trading based on today's share price at NAV? Absolutely, if I could see that earnings growth coming through in that case through the impact of reducing costs post the merger. And that's obviously what we see with something like London Metric. But there's still great value. I mean, Picton's trading at today's at 80p. 2 months ago, it was 65, but the NAV they've just announced is 100. Now, what's interesting about that is every 10 years, these REITs and these trusts are required to change their valuer. So what you do when you change your valuer, your independent valuer, you overlap the two of them. So one shadows the other. But essentially what it means is that for a period of time, you actually get two valuations. And what's fascinating is that in the case of Picton, they obviously had two separate valuers doing the whole portfolio, and the gap between the two valuers was 1%, which I find a very important and supportive statistic in terms of the quality of that particular net asset value. Another one to call out, we have built a position in Schroeder REIT. It's got something like 60% of its portfolio has a lease event, either a rent review or a lease negotiation or a fixed uplift in the next 12 months. So we're confident those earnings are going to keep on powering. And what's so interesting about that particular REIT is it is externally managed, but the manager, the individual at Schroeder's, a chap called Nick Montgomery, has just been promoted to be global head of real estate for Schroeder's, which means he has to step down from running this tiny little 200 million market cap REIT. And they've made a statement in their results yesterday that they are looking for a new manager. At the same time, the chairman, a very good chap called Alistair Hughes, his 9 years as chair expire next year. So this is a business where they're kind of in a process of looking for the two most important people to run that particular REIT. And I've found that in the past, the thing that has stopped most M&A has been turkeys not voting for Christmas. You start with two chairmen and two chief execs, and you end up with one chairman and one chief exec, or one chair. So I suppose in this situation, suddenly you've got a couple of nearly to be empty chairs. So who knows what that means, Jonathan? You can jump to your own conclusions.
I can infer what I might think myself, yes. And I think most of us will be able to infer from that exactly what I think you're driving at. Well, let's return to your main focus, which is TR Property itself, ticker TRY. As I say, you just produced some results and your 5-year record is excellent. You've outperformed your benchmark anyway, the commercial property benchmark over that period. But how would you assess your own performance? I always like asking this question at this point. Could you have done better? Or have you maximised every opportunity that's been there?
Gosh, I thought I dealt with your hard question on this podcast earlier, Jonathan, but you saving the best to last. So here are the numbers for your listeners. We, and I talk about the whole team, it's not just me. I took over from Chris Turner in 2011 and we've beaten the benchmark 13 out of 14 years. And over that time, we've averaged 375 basis points of alpha after costs. Now, that just sounds like a big smoke blowing, but the point of the numbers are that when we look at the year to March 25, we did beat the benchmark, but only in inverted commas, by 130 basis points. So, i.e., a much smaller margin than we have achieved on average over the last 14 years, bar the 1 year of underperformance. And so, essentially, what did I get wrong? It was not to react fast enough to the increased geopolitical risk in the second half. What I mean by that is we saw bond yields move up, and that damaged our exposure to German residential, which has been very bond sensitive. We had some exposure to the most highly levered markets, which actually Scandinavia, particularly Sweden. It's strange, the Swedish property companies all operate with much, much higher leverage. A lot of it's very short term, and that can work really well in your favor, particularly when their economy is growing. But when you have a situation where those rates reverse back up again, the economic growth can't compensate. So the strap line we always use is the nation that brings you the safest car brings you the scariest property company. So you can always remember that one quite easily. The other area is, and this is a function of timing rather than anything else, we own lots of exposure to these small property companies, and it takes time for the market to work out whether these things are mispriced or whether they're cheap for a reason. And where we think they're mispriced, we will just carry on buying those and working, as I say, with management, with the board, to try and get them to either explain their story differently or change their narrative or change what they're doing, or take advice from us as an institutional shareholder. What is it the customer wants type thing? And so you have a situation, and Picton will be a classic case, where at the end of the year, the share price, the end of March, the share price was 62, 63 pence. And we've then enjoyed the benefit of them kicking off that buyback, making sales that we've talked about, and the share price moving up to 80p and hopefully rising further. So some of this is just all about timing. And so whilst it's quite right for shareholders to look at it on a 1 year basis, we also do encourage investors to look at us over a longer period as well. Right now, my gearing is at an all-time high, and I think it is important to remind shareholders and other listeners that I'm not some perpetual bull. Please bear in mind that in Q2 2008, so the quarter before Lehman's went down, we were 20% cash in TR property. Our maximum gearing is effectively 20%. So the fact that we're today at 17 kind of gives you an indication of how optimistic I am about conditions, so rightly or wrongly. And then the other thing that I think people need to take comfort from is skin in the game. And after my house, my holding in TR property, all bought out of post-tax income, obviously, is my second largest individual asset. So it's very much in this together with shareholders.
Well, indeed, and the performance record speaks for itself. And as you say, you have the advantage and the disadvantage, of course, that as an investment trust, you are vulnerable to discount movements. So therefore, it's quite difficult to compare you effectively with non-investment trust property companies. However, I just want to ask you about the dividend. You have a current dividend of 4.8%, I think, but it's not actually fully covered at the moment, or hasn't been last year. What are the prospects for that from here?
Yeah, good question. I mean, as we went into COVID, and property companies had the double whammy of initially the impact of COVID, and then secondly, the impact of rising interest rates, which for businesses that had a lot of short-term debt was very dramatic. And we saw lots of companies either suspend dividends or cut them dramatically. And over the last 18 months, we've seen pretty well all of them come back and begin to repay. And then for the better placed ones, we've actually seen earnings continue to increase. They never saw a drop. But the board have always been very careful about this. As we got into COVID, we had reserves that equaled more than a full year's dividend. So we could have received no income for 12 months and still paid the dividend. As it was, of course, we did receive lots of income, just less than we'd received in pre-COVID. And so we have, for the last couple of years, been dipping into reserves. And that's why the board feel comfortable enough to push the dividend up a little bit, albeit modestly, 1.5% for the year to March 25, because they're confident, and we as the manager are confident, that over the course of the next 12, potentially 18 months at the outside, we will be back to full cover and more and be rebuilding those reserves. And it's really a great credit to the investment trust structure to be able to do this. And in fact, I was on a panel this morning on Asset TV with Annabel Brodie-Smith and a couple of UK equity income trusts talking about dividend heroes. Dividend heroes being having more than 20 years uninterrupted. And we would have been comfortably in that if we hadn't held the dividend flat in 2010. So as the consequence of the GFC, we would have been well and truly into the dividend aristocrat territory. So with the exception of 2010, we've increased the dividend every year for over 25 years with a compound annual growth rate of, I think it's about 6.5% now. So it's all about, that's what real estate should be delivering. And that's very much, whilst my mandate is to beat my benchmark, I also need to be able and cognizant of the need to deliver that steady dividend growth as well.
So the final question then on that point, I just give you a chance perhaps to make your marketing spiel again, I suppose, but I'm just saying, when you compare that, for example, you can get 6%, a bit more sometimes on some of the sort of classic REITs, land securities, those sort of people, British Land, and so on, and you're around 4.7, 4.8, something like that. How would you sum up justifying why people should put money into your trust, which is admittedly not the same kind of vehicle, as opposed to some conventional big beast in the commercial property world?
Yeah, it's a totally fair question as well. And I think the answer has three parts to it. The first is that I'm investing in companies and I'm buying them at their market cap, which is obviously a big discount to their asset values, whether you believe the asset value or not. And then you're buying TR property on an 8% discount on top of that. So that's your first point. The second is that TR, for those with a long memory, including yourself, Jonathan, TR originally stood for Touche Remnant, which was a fund management business bought by Henderson in the 1980s. And we were originally part of the Henderson stable, and we moved to a business called Thames River Capital in 2004. And we always told the founders of Thames River, Charlie Porter and Johnny Hughes Morgan, that we went there because we didn't have to change the name, which we all thought was hugely funny. But of course, it wasn't the reason. It was because we wanted to go and work in a boutique environment. But actually, post the sale of Thames River to initially F&C and then Bank of Montreal, now Columbia Threadneedle, we say the TR stands for total return. And so what is the difference between buying a high-yielding name that essentially is going to have slower growth? In TR Props, you are picking up a 4.85, let's call it rounded 5% dividend yield, but you're getting that opportunity to capture that additional capital growth. Now, that might be through M&A activity. It might be through the fact that we are backing businesses that we are confident are going to see really quite significant asset growth, either through their development programs or through cost cutting, or just through organic rental growth, or again, through more M&A. And it's just that opportunity for that diversified play. And I think those really are the three reasons.
Very good. So on that note, I think that brings us to the end of another stimulating conversation. So thank you, Marcus, very much for joining us. I know that our listeners find it very interesting to hear your take on what's going on in the commercial property sector. And as you say, you've got many years of experience behind you to back up what you say. So thank you very much indeed. I look forward to seeing, I hope, that the way you've described it, the things turn out, continue to improve. And so thank you very much indeed for your time.
Thank you very much, Jonathan. Very nice to see you. Goodbye, everybody.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.